Is DSCR the best loan for rental properties? Hey everyone, it's Mike Bonn with Cash Flow Company. Today we're going to go over the 3 top popular loans for rentals, and is DSCR the best loan for your rental property? Now there's 3 main loans that cover rental property loans, especially fourplexes and below, and that is the traditional loans, Fannie, Freddie, you have DSCR, and then you have small bank loans. Anybody that ever comes to us, we always look through it through the lens of what's their best option. Typically, when we're talking about rentals, we're talking about cash flow. What is the best cash flowing loan? So we're going to go through the benefits of each of these 3 traditional loans, small banks, and the DSCR, and show exactly where they fit. Because the truth is, if you're an investor, and if you're an investor that's doing more than 5 or 6 deals, you're going to need all 3 of these or use all 3 of these sometime in your life. So it's good to understand them and know when it's best to use a DSCR compared to a small bank loan or a traditional loan. If someone comes to us, and the benefit of being a broker offering different products from hard money all the way to bank financing is that we could give clients options, and we're always looking for what is their best option. If everything is equal, credit, income, everything else, we're just looking at cash flow and what makes the most sense. The benefits and negatives of traditional loans when you're talking about rental properties are, number 1, it's a 30-year mortgage. Number 2, unlike DSCR, and I'm not here to talk about one is better than the other, I'm just saying each has their own place. Number 2 is no prepay penalty. So you could get in and out of the loan whenever you want. If the market goes up, you want to sell, you could do that without worrying about a prepay penalty. And of course, rates. I mean, if you're looking at DSCR and you're comparing the best of one to the best of the other, you're at least a point different in interest rates and maybe even some of the closing costs. So on a $100,000 loan, it might not mean as much, but you get into the $400,000, $500,000, and $600,000 loans, a point going from 6 to 7%, for example, is a big difference in cash flow. Not only cash flow, but even being able to be approved. The higher the rate, especially on traditional or anything else, impacts your credit score, but it also impacts your debt ratio. Another huge benefit of traditional loans is home hacking. You could actually, in a duplex, triplex, fourplex, you could actually live in one of the units, do an owner-occupied loan, get a lower down payment, get a better rate, and able to at least live in one of the units, and then do this every year to 2 years, going from one property to the other, and always use an owner-occupied. So one of the limitations of conventional traditional loans is that they limit you to 10 properties or 10 units. That's all you can do is finance 10 loans outstanding in the traditional world. So if you're going to use them and you want to use them, get the best rate, the lowest down payment, maybe you go house hacking. DSCR does not allow you to live in any of the units. Here on the owner-occupied traditional loans, as long as it's a 2, 3, or 4plex, you can live in one of the units. Another thing is the same rules, the same conditions apply across all 50 states. Conforming traditional loans are the same no matter where you go. Traditional loans are used in the same underwriting in 50 different states. Now each lender, each bank or whatever may have a little bit stricter guidelines, but it's the same across all states. Now, as an investor, some of the negatives, you are going to have to prove your income. You are going to have good credit, and you cannot close in an LLC. You cannot own the property when you're going through the purchase or refinance in an LLC. You have to close it in your personal name. So that's a negative, and that's where you can see that each of these products as we go through, there's a place and point for each property, each time in your investing career. Maybe you don't have the income, or maybe you've already gone through the 10. So you have to have a place for each one of these. The last is with the new cash out refinance. It's now seasoning of 1 year. So you have to have the current mortgage on the property for 1 year before you could cash out on that rental property. So if you're doing BRRRR or just want to tap into some of that equity with a full refinance, you're going to have to wait 1 year since your last refinance and or purchase. Next, let's go over DSCR, because DSCR is the other popular product out there for single family all the way to fourplex. But one of the benefits of DSCR is the flexibility now. Since it is a unregulated, it's not a Fannie or Freddie product, all these investors can make up their own rules, terms, everything. So they're becoming more flexible. They're going up to 8, 12, 24 plexes. They're doing blanket loans. They're doing unique properties, condos, non-warrantables, VRBOs, the flexibility with DSCR as it expands, as the investors find out they want to be more and more involved in it, opens up more products. So there's mixed use. There's just different things you could do with the DSCR on different kinds of properties than with the traditional loan. And of course, the biggest benefit of DSCR is ease. It does not matter if you're employed right now. It does not matter what your tax returns say. Income from personal or business is not even needed. You don't even put it on the application, anything else like that. It is all about the rental property and is a cash flowing. And even if it doesn't, there's a DSCR loan for that. Another big thing in the real estate investor world is closing in an LLC. You could buy it in an LLC, you could refinance it in an LLC, all under that umbrella of the LLC. So you're protected all the way through. So there's no gap of you owning it part of the time in the LLC. DSCR is set up for business people, and in that they're looking for business loans. Typically, they actually want you to have an LLC. It's also available in all 50 states. It may be a little bit different rules and regulations because unlike Fannie and Freddie that have one underwriting guidelines, these are made up of segments of different Wall Street pension funds, everyone else who funds them, and makes up their own terms, guidelines, everything else like that. So always shop around, always look around, especially when everything is not always the same on each transaction or where you're at in your investment career. There's options if, like Fannie, Freddie, we said you're limited to only 10 loans. Doesn't matter if owner-occupied or rental, just 10 loans. DSCR, there's a lot of lenders who do not care how many you have. Like I said before, they could even do a blanket loan on $50 million worth of properties, 50 units, 500 units, whatever it is. They don't always care. You have to shop around again because some do, but most don't. As underwriting gets easier, terms get easier. They're all looking for better deals out there. So you're not limited to just going up to 10 with like a traditional loan. Now there are negatives, as we've mentioned before, DSCR. Number one is prepayment penalty. If you're looking to get in and out of a property or you don't even know within the first 3 to 5 years, there's a prepayment penalty unless you buy it out. So that could be another cost on top of rates. Remember, rates are a little higher. From anywhere from 1 to 3% higher than traditional loans, just depending on your credit score, size of loan, and all that stuff. So cash flow is impacted the lower the credit score and the higher the loan amount because interest will have a big impact the larger the loan. Here's another thing we found out with DSCR over the last 5 years. When things change, they disappear for a while. When COVID hit, they disappeared for months until they figured out that COVID did not affect real estate. And then when the Fed started raising rates last year, they kind of disappeared, pulled back a little bit. If in times of uncertainty, a lot of these products seem to disappear, go away, change rapidly. Unlike traditional loans that will always typically be the same, slow moving, slow changing, DSCR loans, when the economy or anything changes, they change quickly, and sometimes that's not to the benefit of the real estate investor. Now, when we look and talk to investors who are buying or refinancing rentals, we always bring up a third option, and that's local banks, because a lot of local banks, smaller banks, offer in-house products. And when I talk about in-house products, I'm talking about loans that they fund and keep and accept payments, service the loans. They don't just broker it out, because a lot of banks also offer traditional loans like the 30-year product. We're talking about the loans they keep in-house that are usually a 3, 5, or 7-year fixed, and then they either become adjustable or you have to refinance them. In those periods where you're looking for a shorter loan, more flexibility, all those things, small local banks, depending on your region, your area. For instance, we do a lot of stuff in Oklahoma. The banks are the small banks, very flexible, love real estate investors. Certain areas do, certain areas don't. Small banks, you have to shop around. We'll go over that as one of the downsides. You have to shop around, see what's happening, and be flexible. But when you're a real estate investor, small banks can be a great option because they can do one property. They can do 4 properties. They have the flexibility. The property can be a little bit unique. As long as they understand the area and what they're lending on and they like who they're lending to, flexibility is there. And rates are typically in between the traditional and the DSCR when they're lending. So it's a little bit better rate than DSCR, probably not as good as the traditional, but flexibility is there. Another thing with local banks, they don't have the prepays. They also like small towns, local communities that they're in, even smaller loans. We see a lot of these in some of the rural properties in Texas and Oklahoma. Maybe someone's all into a property for $50,000 or $75,000. Small banks love the small loans. Of course, they're going to want good income, good credit. They're going to check all those things, and every 3, 5, or 7 years, you're going to have to reapply. But they fit. There's a great fit for certain deals. And that's why working with someone who has all these options, they can make sure that property that you have right now, where you're at in your investment career, you could actually be in the right position with the right loan, getting you the best cash flow with ease. Now, there are some downsides, of course, with small banks. Number one is every small bank is different. Everyone makes their own rules. The people who own it, the presidents, whatever, they make their own rules. So you have to shop around and continue shopping around. They also have lending limits. It's sometimes easy to hit those. Maybe it's a couple million, maybe it's 3 million. If you're putting a portfolio together or doing multiple properties, sometimes you hit up against that lending limit. Or as things change, they get too many properties, real estate in their portfolio, they have to stop lending. One of the big negatives is you have to shop around, you have to find the right ones, and they could change, just like DSCR, a lot more than traditional loans. They also limit their areas, because if someone's in the Tulsa or Denver market, they're not going to go too far out of that market, even within the state, because they have a footprint that they lend in. So sometimes working with small banks, you have to find banks that are within your region or where the properties are. Another thing that can come up, and especially in really uncertain economic times, are all of the loans with small banks are callable, which means if they feel like the values have gone down, if something has changed, they could call the loan and make you pay it off or refinance it somewhere else. Fannie and Freddie, DSCRs, they don't have that. Some small banks do, and most banks, that we've dealt with in the past, they've had those. But it took something like 2008 or some kind of big event for them to actually go and call them, unless there is a big decline in values. And they may get to the point where if values go down, who knows, they could call the note, which means you have to pay it on demand, and it's not going to last that 3, 5, or 7 years. So there's a little bit more risk with the small town banks. All I'm trying to say here is DSCRs are great, traditional is great, small town banks are great, depending on the property, where you're at with income, credit, all these different pieces. Where does it fit in? We're trying to maximize income. We're trying to maximize cash flow. And each property and or where you're at, maybe your credit score is a little bit low right now, or your income's way up and it's better to go traditional, or you used all your traditional, where do you go next? It's strategizing, making sure you understand all the lending options out there to put you in the best cash flowing leverage you could find. Besides helping people get the best product, the best rate, the best terms, for real estate investment properties, there's also some great free tools on our website, the Cash Flow Company, that you could download, including like the DSCR calculator, that you could go out there, use that, figure out if something's cash flowing, see what the DSCR ratio is, because the better the ratio, the better the cash flow for you, and the better the rates you're going to get on a DSCR loan. If you're buying a rental property or refinancing one, want to know if you're getting the best terms, if it's the best option for you, reach out. We'd be glad to send you out and let you know if it's a good deal, bad deal, or if we could do better. I hope these videos help you become a better investor. We'll see you on the next video.